Friends, good evening to all of you. Thank you for joining this webinar on PMS that we've been wanting to host for some time. And I'm sure a lot of our clients and friends who are interested in our PMS would be wanting to hear it from us and how we have been doing. Briefly, firstly, there are a lot of people who are our clients and who have been, in relationship with us, been associated with us, but there are several others who may not have been working with us. And so let me give you a brief on SATCO. SATCO is a full service broking entity registered with NSE and BSE and CDSL, MCX, providing all kind of equity broking solutions to its clients. Along with it, we are also on a wealth platform, and we have a SATCO Wealth that looks into distribution of mutual fund, insurance, other assets such as bonds, fixed income, and of course, PMS is the feather in the cap. PMS has been doing wonderfully well, as will be taken up by Nitin. We have had an excellent track record last 8-9 years. And this has encouraged us to, further take this on further and, introduce you to what we have been doing, the growth and momentum strategy. Last few months have been tumultuous for all of us. You know, with post-COVID, the world has undergone change. The new normal, a lot of changes, businesses that were at one point in time pre-COVID doing wonderfully well. Many such businesses are out of tune at this point in time. Many others are facing challenges that they have never seen in their life of the life cycle. And so we as PMS have taken a conscious view of how to go forward, how to restructure our portfolio to see that those businesses which are not, which are COVID-proof, as one would say, we have invested in such kind of companies to see that portfolio is vibrant and continues to give good returns. Driving the PMS, of course, is Mr. Nitin Raheja. He's the fund manager, very well experienced gentleman of more than 27 years in financial sector industry. He has driven various funds in his previous avatar with Enam, with Sun F&C, and with Dawnay Financial Services. He is heading the SATCO PMS as a fund manager, growth and momentum. And let us now take it out from Nitin and hear more about growth and momentum strategy. There's a question answer module at the bottom of the screen. I'm sure many of you may have some questions on the scheme and all those. Please punch in your questions there. And after Mr. Nitin is through with his presentation, we will take those questions and try and answer all those questions. So over to Nitin. Nitin, welcome.
Thank you, Naresh,
yeah,
for the kind words. Good evening, everybody, and thank you for your time on Friday evening. I hope you all are safe with your family at your homes, and I wish you all the best through these very, very challenging times, which is probably like a once-in-a-century event that we all are seeing, whether in life or whether in markets, and so on and so forth. For our PMS investors, I am very, very happy to share this news that our PMS has done extremely well, and at various forums, we have now been recognized as one of the top performing PMSs in our category, which is in the multi-cap strategy category. And even if we take it broadly across different genres of PMS, we stack up pretty well in the top quartile. It's been a fruitful 9.5 years since we've been managing the PMS, and I'm very glad to share with you that we have so far over a 9.5 period delivered almost a 28% compounded annual return. Now, we thought that, and we've been wanting to do this for some time, to come and talk to our investors and possibly people who are new to our PMS. And there is a lot of confusion. There is a lot of every time you open the television, you open the newspapers, you only see bad news as far as the economy is concerned, as far as the data, as far as the COVID infection is concerned. And at the same time, contrary to that, the stock markets have actually rallied and rebounded dramatically. And so one of the most common questions that I keep on getting from people and investors is, what is this happening? Why is this happening? And do you think this will sustain? And a lot of our investors also ask us that, they want a view in terms of what's going to happen to their portfolios. So we thought we will take this opportunity, and thanks to technology now, I think we have taken a conscious call that, almost on a monthly basis, we will be talking to all our investors using this forum to address their queries, their questions, and hopefully, give them a better understanding of where they have invested their money, and so on and so forth. So I will quickly run through a very, very quick and brief presentation, and I would love to make it interactive post that and hear more questions from you. My colleague Jay will be taking the questions and asking them on your behalf. So I will just quickly share my screen and dive into the presentation. Right. So as the presentation says, the road ahead. So we've just tried to put some of our thoughts in terms of how we see the scenario and what we think will be the road going ahead. So as I said, we've tried to make this into a sort of a question answer format. And there are three broad questions that we have tried to answer in this. First one, which is the most paramount among people, is why are the markets going up when the economy is struggling? Well, clearly, we have seen this data around, right? The US is probably seeing the sharpest ever contraction in GDP it has seen in the last 50, 60 years, as the red line or the chart shows. And even coming back is going to take it at least 3 to 4 quarters, for it to really start coming back. The picture is no different as far as India is concerned. We are seeing that GST collections saw a V-shaped bounce back, but that is because it's a little misleading, because there were 2-month figures which were bunched together, for the month of June. Manufacturing PMI is clearly showing you, and generally speaking, PMI data is an indication of what's the state of the economy, what's happening on the manufacturer. Any PMI over 50 is regarded as decent, not good, mind you, but decent. And we can clearly see that the PMI data are showing that we are operating at a bare 50% of our capacity. So is the services PMI. Services has been the backbone of this economy all these years. Unfortunately, the lockdowns and the subsequent events have resulted in a huge chunk of that economy, whether you talk in terms of the airlines, whether you talk in terms of hotels, whether you talk in terms of restaurants and other such small businesses, seeing immense pain and continuing to see pain at the present moment. So what has the government and the Fed done? Well, in the US, they virtually took out a bazooka. And you can see that. You can see that the money supply numbers have just gone up like a hockey stick. The Fed has expanded its balance sheet absolutely dynamically. Well, they can do this because they are the developed economy. They are the economy which has the currency which is the reserve currency of the world. The net result has been that bond yields have come down to near zero. These are absolutely unprecedented times. When you see this kind of bond yield, you clearly see that alternates for people to put their money is reducing more and more. A very similar picture, while the government stimulus has not yet come, we've seen the RBI do its bit and come up with stimulus, liquidity. And one of the first few things that they did was they tried to address the fear in the system that seemed to prevail and the panic by flooding the system with enough and more liquidity to see that there is no collapse of the system. I think they've done a commendable job. There has been almost a 70-80% retraction in terms of the yield difference between AAA and even below as such. The difference was huge. That has come down. Net result has been interest rates have come down again. And it is significant from a perspective that if you consider that if 2 years ago you were retiring and you had your wealth lying in a bank or in certain fixed income earning about 8%, and maybe in corporate bonds earning 10%, suddenly now you're seeing that same bank is only paying you 4.5% and 5% and so on and so forth. So it dramatically changes the way you are going to live your life. And that is causing huge changes in asset allocation. But net result has been, you can see in the last 3 months, there's been almost close to $5.25 billion of inflow from FIIs. The domestic institutions continue to pump in money. So if you really see what has happened is globally, banks and governments in places have pumped so much of liquidity and cheap liquidity into the economy. This has really made the markets delirious. This cartoon kind of sums up the state of the markets. It's yet seeing stars with the kind of steroids that the Treasury and the Fed have pumped in. And, net result, from the lows of March, you have seen a recovery which has been unprecedented. The kind of bounce backs that you've seen, whether it's the NASDAQ, whether it's the Dow Jones, whether it's the DAX, whether it's the Kospi, Nikkei, and our own Nifty, and so on and so forth. So while the correction was 38% from the bottom to the bottom, for the Nifty, it was almost in line with all the rest. The bounce back has also been very, very sharp. So as a result, we are barely around 8 or 9% away from the peak that we saw in January as such. So, in a nutshell, if you were to ask me why the market's going up when the economy is down, it is pure liquidity chasing stocks. It's pure lack of alternatives, because if you ask anybody, they're only seeing 2 areas where they can go and put their money to be safe. So some people are going to gold, some people are going into equities. Also, there's another phenomena that has happened is with the lockdowns, the human tendency of wanting to actually do something has seen a whole new class of investors sign up and enter into the capital markets. These are people who are trying to be short-term traders, trying to see how they can, use their savings and, generate a better return while they're sitting at home, and, believing that since the markets are going up, it's easy. And for some time, yes, it might look very easy, but it's always a rude shock away when, corrections start again and these traders get, caught on the wrong foot. So having answered that, the question yet remains that, what should one be doing? And, when the economy is showing such a confusing picture, and, mind you, from the beginning of the cycle, I have been tracking and hearing analysts and experts all over the world. Frankly speaking, when things were going down, everybody was predicting initially optimism in terms of how much it would go down, then extreme pessimism. Now, when things are going up, people are, suddenly a little pessimistic about things going up. So I think till that pessimism doesn't wear out, and full optimism doesn't come, we've never seen markets correct as such. So we said, look, you can talk ad infinitum about markets. You can talk ad infinitum about the economy. And frankly, none of us will be wiser, because honestly speaking, none of us really know where markets are heading. And it's like a weatherman's job, that trying to predict where the weather is going to be. You will probably find that they are wrong most of the time than they are right as such. So we said, let's see, ultimately we as portfolio managers are not investing in the market. We're not buying the Nifty. So we said, let's see what has happened. And so in the past, and what is the holy grail of investing in terms of during such times. So we went back to the global financial crisis. We said, let's look at the stock markets right all the way to 2007, or when the markets previously peaked. Let's see the number of drawdowns in this phase, which is almost 12 years, and see which are the kind of companies who actually did well and performed well. So while we were doing this, in this 12 years, we saw 4 broad drawdowns. And when we defined drawdowns, we said when markets have corrected more than 20%. So the first drawdown was the global financial crisis, when the markets fell 60%. And from peak to trough and back to its original was a 1,032-day journey. The next one was what we call as drawdown 2 in December 2010. Around that time, that's where the Eurozone crisis erupted, and the global economy started slowing down, and corporate earnings in India also started slowing down at that time. So that's when the market fell 28% during the peak to trough and then coming back. And this was about, again, a 900-odd day cycle. The third was when the Fed, or what we call as the taper tantrum time, when the Fed decided to raise interest rates, because they said, look, we have pump primed the economy enough, and now we're going to move towards a rate hike or a tightening stance. The Greek crisis was there, the yuan got devalued, so all put to, and China slowdown fears. We had a 23% correction, which lasted 500 days or something. And the fourth one we have classified as the current drawdown, where we saw a 38% drawdown and now a bounce back. Now, so what were we trying to aim? So we said, the next step we said is, okay, we put it on a chart, and we said, let's look at companies who, at least if you had invested at the peak, because none of us really know what the peak is, right? We are all wiser in hindsight. So we said, let's see if you had invested at the peak in the markets around that time, which were the companies in the 500 index, the CNX 500 index, who delivered at least a 15% CAGR return over the period where the market came back to its original level. And we found, that in the drawdown phase 1, the first drawdown, there were 101 companies through that vicious drawdown who yet delivered 15% CAGR numbers, minimum 15% and above CAGR numbers during this period. In the second drawdown, there were 63 companies. In the third drawdown, 115, and now there are 112 companies in this current drawdown. Now, the drawdown was 60%, 28, as I just showed you in the slide. But this sample of companies fell much less than the market. So they fell, as you can see, and actually outperformed the market in each of these stages. So they fell 46% in the worst global financial crisis. And this sample of companies has fallen 26% in this current crisis. In the other two, they did much, much better. But very interestingly, when the bounce back came from the bottom, right? So the markets bounced back 150%, 36, 28. So, essentially, Peter Lynch once made a statement that if you did not stay invested through market cycles and you tried to time the markets, the first few days from the bounce back is when you got the maximum return. And if you missed that maximum return and took those days out, then the average that you earned from the stock market was not very different from what you would have earned from fixed income. Right? So because the bounce backs, the falls and the bounce backs tend to be very sharp. So it's often very difficult for people to get in and get out. However, this group of companies actually bounced back far more, almost by a factor of 2, anywhere between 1.5 to 2 times the market bounce back. So the first bounce back was 252% from the bottom. 88% in the second, 50% in the third, and 83% already in the fourth as such. Now, during this period, the market was flat because we said we were tracking markets from the time they went down from the peak and came back to the peak. But the absolute return that you would have earned by investing in such companies would have been a very, very handsome number, 91%, 81%, 56%, and so on and so forth. So then we said, what is the characteristics of such companies, right? And one very, very clear characteristic we found is growth. All these companies are high growth companies, but with very strong balance sheet characteristics. So if you can see, these companies who did well through this turbulent phase had huge profit growth numbers, 29, 33, 33, even 22 in the current one. And more importantly, the balance sheet strength, the return on equity was a very high, plus 20% numbers. So the message that was very clear to us was that if you stay invested in high growth companies, and companies with sound balance sheet, these companies not only come back strong from the bounce back, but actually deliver very handsome returns. So, getting overly obsessed with what's happening with markets or what's happening with economies can very often, take away the main picture, which is that you are not invested in that economy, or you're not invested in the overall macro market. You're invested in companies, and those companies who do well will deliver returns to you. Now, just to give you a perspective, our own portfolios during this phase had a max drawdown, if you look at D4, had a max drawdown of around 29%. So very much in line with this group of companies. Our bounce back has been 61%, and it's been less than this group of companies, which is fine, but more than the market, because roughly we've held 20% of cash in our portfolios. So if you adjust for the cash, actually it would be in line with this group of companies. So now, jumping very deep, what was our PMS strategy at such a time? Actually, not a lot different from what we've always done. If you recollect, for the benefit of all our PMS investors, we've always said that the central ethos is we are growth investors in our portfolio. We look for companies who are doubling earnings every 4 years, because data has shown that PAT growth results in a multiplier to market cap growth. And this data has been shown and demonstrated over multiple periods of time, as you can see. In the case of large cap companies, it's been 1.08. In the case of mid cap, it's been 1.2. In the case of small caps, it's been 1.23. So this has been the ethos or the central investment philosophy which we follow. Of course, there are various filters that we applied. So factually speaking, as I told you, we do nothing different than what that data was showing. That data only further validated that what we were doing has been right in terms of its philosophy. And that has resulted in this type of winners that we have seen in our portfolio over this period of time. In fact, we've been holding some of these stocks, like you can see. Bajaj Finserv has been in our portfolios from December 2014 till date. We've had other stocks like, for example, Indraprastha Gas from 2016, UPL from 2013. Mind you, everybody talks about Bajaj Finserv and the NBFC, but UPL is right up there in terms of returns, and so on and so forth. So what this tells you is that these type of companies need to be held for compounding to work for you to make money. And if you try and be very, very smart and say, I will get out, I will move in, you really do not, the only reason you can get out, and let me give you an example of Vaibhav Global. Our first investment in Vaibhav Global was in 2013 or 14, I don't remember, but we had invested around 100 rupees. The stock went to 700, we got out. At that time, the business fundamentals changed, and hence we got out. And only around after 2 or 3 years did we get back in, when we saw that the challenging times were past, because we liked the business and the management. And again, it has proved us and given us humongous returns. So effectively, if you really see, even if I had not done that and been very smart about getting out, and I would have held it through that weak phase, a 100 rupee stock was yet delivering 1697. So frankly speaking, whether I got in or got out and got in, or I would have held in, I would have actually had the same results. So, so what did we do? Now this comes to our portfolio. I thought we will just share with you how we positioned our portfolio. So as we entered, and as we were entering the COVID, actually even before the lockdown, the economy was slowing, and discretionary retail was the only engine which was driving this economy. Discretionary retail, as we call it, or consumer, where we classify automobiles and all, was slowing any which way, even before we got into this phase. So we had a large component of non-discretionary retail, or small ticket discretionary retail. So what I mean by is, we owned cinema theaters like Inox, because we said, even through a slowdown, people yet go and watch movies, and so on and so forth. We had an exposure to retail. However, in Jan, Feb, as COVID started, we got a little nervous, because as numbers started rebounding, were increasing, we said, retail spaces are the first ones at risk. We, in fact, also had hospitals in our portfolio. So we said, these are areas. So we actually, before the lockdown started, we had, started reducing our exposure to some of these sectors. However, once the lockdown started and, everything, all hell broke loose as such, and markets collapsed, we, as a first step, we first actually went into cash and said, let's wait and see how things are panning out, and then try and assess how we will position our portfolio. So while we took a very aggressive cash stance at that time. In fact, we were 30% plus cash in portfolios. But then we went and deployed, we did something very uncharacteristic. We went and deployed 5% in gold. Theory was very simple, that look, gold has been seen as a hedge against uncertainty. And there was tremendous uncertainty at that point of time. So we said, let's buy gold through the liquid gold piece in our portfolio and keep it. It's better than sitting on cash. At least it will, if not give the same money back, or marginally better than cash, right? We did not know that it would give us a handsome return of almost 20% in our portfolios as such. The other thing is, we were already holding pharmaceuticals, we were already holding chemicals, so we did nothing different. We didn't, in the sense that today people talk about chemicals and pharmaceuticals, we were already there in those companies. Gas has been in our portfolio. We are referring to City Gas, which is, companies like Indraprastha Gas and Gujarat Gas has been in our portfolio for the last 2-3 years. We continued to hold. In fact, what we did is we increased our weightage, because our thought was that these are sectors which are essentials. And whenever the economy opens up, these are sectors which will see natural demand. They are rather, if you were to call it, demand inelastic, and cars will be taken out and CNG will be used. Household gas will be used even through while you're sitting at home, and so on and so forth. The two sectors that we actually added at that time were agrochemicals, because of the strong stimulus that the government put out for the agriculture sector, in terms of the minimum support price of food grains, in terms of actually using the buffer of food grains and distributing it. So, and also the monsoon forecast being good. So we said agrochemicals. And telecom for us was a realization that as we were working from home, the way we were talking to each other, we said, look, it just seems that data is getting more and more consumed, and telecom to us looks like a sector which is a good hedge. So we said, okay, this part of the portfolio, which is almost 44% in these segments, with gold 5% and cash 5%, we have 12% as a strategic asset. this is almost 61% of our portfolio is, if you were to call it, hedged against COVID. Added to that, we had a lot of companies in the mid and small cap segment, which had very strong growth characteristics even at such times. So here I'm referring to companies such as Web of Global, or even an Apollo Tricord, or even if you were to take an IOL or an Indian Energy Exchange. So these are mid-cap companies which had common characteristics. A, they had strong visibility, very strong balance sheets, with high return on capital ratios and very low levels of debt. In fact, we looked at the aggregate of our portfolio, excluding financials, and said we want companies where there will be minimal debt characteristics in it. So except for telecom, where we own Bharti, which has debt, but which is more like a utility and should take the upswing. Most of the companies, whether it's chemicals, pharmaceuticals, agrochemicals, gas, even in our mid cap, were companies which didn't have a lot of debt or were paying down debt. In fact, uniquely, when we look at our companies in March, and when we look at our companies today, we see actually all of them have reduced debt significantly. So they were already directionally moving there. On the financials, which was, if our PMS investors recollect, at one point of time, at the peak of the NBFC boom, we had almost a 35% plus weightage for financials, with a lot of NBFCs in our portfolio. And because of that, while we did very well at a point of time and made investors a lot of money, but because of that, we also suffered in 2018, which is probably the only negative year we have in our 9.5 years. But what we did and took a stance on NBFCs is, we said, look, we reduced it, the lending and financials, to all the way down to 17% weight, because we said these are stressful times. More and more accounts can get stressed, and you will see trouble. And the longer this continues, you are going to see stressed assets go up for almost every entity. Within that, we said, let's look at the leaders, the ones who are managing the best, who have the best managements, the best risk management practices. So we said the top 3 private banks, and we said within the NBFC space, we restricted ourselves to 2 NBFCs. HDFC, who we think honestly we're very excited with HDFC going ahead, because we think this whole shakeout means HDFC will only consolidate and become an even big leader in its field of mortgage finance. And Bajaj Finserv, which is a quasi, it's a conglomerate, because it owns the finance company and it owns the general and the life insurance business. So we reduced the weightage of these financials all put together to 17%. These are also, by the way, financials. If you look at the entire financial chart and take out the gold financials, which have done really well, these are the financial stocks which have actually lost the least among their peer group, and so on and so forth. So we restricted that. So we broadly made all these changes in our portfolio, and that really helped us to bounce back almost 61% from the peak. Again, like I was telling you, if you take the Q1 numbers that have come, our companies, this is excluding the financials, if you take, has yet in such a time where the economy has degrown, where if you see the index companies have degrown, have grown 10% their sales. If you see their EBITDA growth has been 23% and the PAT growth has been 26% as such, which tells you why they've performed the way they've performed. And if they're doing so well in such challenging times, there is no reason to believe that when the economy does come back fully, they will not do much better. Even our financials have seen 16% growth as far as their net interest income and 15% growth in their PAT. So, as I said, tracking companies who are growing, have quality management and strong balance sheets, has done what it has to the portfolio. There is no rocket science behind what we are doing. It is plain simple growth investing. And the result of this has been that over 9.5 years, as you can see on the chart, we have delivered and outperformed the index in every single year, and except for 2018, where we took the brunt of the NBFC drawdown. This tells you how much our earliest investor, who is yet holding, has made on his money. That's 28.7% compounded annual returns. And all this has meant that if you really look at it, in the latest PMS Bazaar, which collates the data of all PMSs, in our category, which is the multi-cap PMS model, where we use a model portfolio approach, we are there at the top. If you see whether on a 1 month, on a 3 month, on a 6 month, or on a 1 year basis, or a 5 year or a inception basis, or even within the 3 year basis, we are in the top quartile. If you take all PMSs in the multi-cap, which is people who follow a pooled account structure and a model portfolio structure, you will see again our performance is within the top 10% as such. With if you take the longer tenure of 1 year and 5 years, and since inception, we are actually among the top 3. For funds who have actually, a lot of PMSs have come, in the recent past. So some have shorter track records. So we said, our competitor essentially are people who have been around as long as we've been around. So we said, how do we stand up among funds who have at least been there for 5 years? Because if I am telling you that we invest in companies doubling earnings in 4 years, so to have a full cycle, we said, let's look at companies with funds who have been around for 5 years and more. Again, out of these 58 funds in that category, we are in the top 10%, except for the 3-year period. But in all other period tenures, we are more notably in a 1 year period, we are number 1 yet. Since inception, we are number 1. So that has been the result of the approach that we have followed. And I must also thank you, our PMS investors, for the faith that you have reposed, for the patience that you have reposed in us, and and I would look forward to hearing more questions and having a lot more interaction with you. Thank you. I'm done with the presentation. We could open up the floor now.
Yes, Nitin. Yes. The forum is open for Q&A. Please write your questions in the Q&A box. Nitin, since we'll wait for the questions to come in, let's have a look at the questions that came in on email before the seminar started. From an NRI investor's perspective, what is your view on USD INR? Do you think the rupee will further depreciate against the dollar?
That's a good question. When this crisis erupted, in a normalized scenario, you would have by now seen a very strong depreciation in the rupee, with the FII selling out and so on and so forth. However, there are two very interesting aspects that have been taking place in this country in the last few years. One of them has been that, when we look at a rupee depreciation, there are, let's break it up into 3 or 4 buckets and categories, right? So how do we get dollars in the country? Through exports. How do we get through remittances from the Indian NRI community, through FPI or FII flows as such, and through FDI, right? Now, what has happened in this last 6 months is that in the normalist scenario, you would see all of this starting to outflow and a strong depreciation in the rupee. So while exports have not yet grown, but a lot of these sectors that are doing well, the pharma sector, the chemical sector, they are all export-oriented sectors, and so on and so forth. And with this whole Make in India or Atmanirbhar concept coming about, these sectors have been focused on and talked about where investment will come. So that's although long term, but okay. But keeping that aside, also what has happened is that you are starting to get many more of these so-called startups in India over the last few years who are actually bringing in big amounts of capital inflows from private equity and venture capital funds in the country over the last many years. And then now you've had this whole real estate sector opening from a REITs listing perspective, which again sees, you will see more than the Indian investors, you will traditionally see a lot of money coming in from global investors like the government of Singapore and so on and so forth. So you're seeing money coming into these so-called startups in a very big way. Second, you're seeing a lot of Indian corporates out there in the market raising capital. So, Reliance raised a record amount of capital. HDFC Bank has raised capital. ICICI Bank is in the market raising capital. Access raised capital, and so on and so forth. And a lot of Indian companies, PVR raised capital, and so on and so forth. So there is again a dollar inflow coming in from there. So while exports are not doing well, remittances have slowed down given the current scenario. You are seeing a jump in these kind of flows having come in. Further, the fact that interest rates are almost zero means that you're seeing FII flows move into this country. So all of this is actually holding the rupee to where it is. My own view really is that I don't see a tremendous depreciation as far as the rupee is concerned. And if you see historically, from an NRI perspective also, if you take a long-term chart, obviously the rupee will depreciate to the extent of the inflation difference between the US and India. But this does not happen on a yearly basis. This happens like a step function. So you will have one massive depreciation and then it's flat for some time. Then again, there is a depreciation and then flat. So I think the recent depreciation that we've seen and taken the rupee to wherever 75 will mean that I really don't see the rupee depreciating in a very big way unless and until there is an untoward political event in India. Because frankly speaking, I think a political event more than an economic event in the short term will cause any fluctuation as far as the rupee is concerned.
Right. We have a next question from Mr. Prakash Tulsiani. Do you believe crisis is over? If not, from point of view of earnings, when do you expect bounce back?
So I think if you ask me, I don't think the crisis is over. Every day you and I are having access to the same amount of data in terms of the number of cases in this country are going up. However, I think the shock of the crisis is over, right? And stock markets don't like shocks. So in March, we were in a state of shock. We had a shutdown which we have not seen in our life. The COVID was, people were fearful even of moving out of the house. People are moving out of the house as such. So the shock of the crisis is over. So I don't think the COVID is going to cause any further damage to the economy, to the stock markets. It's going to be earnings which are going to, which is play out. Now, I think to come back to earnings, frankly, if you ask me, I don't see us coming back till financial year 21-22 end to where we were prior to that. Except, as I said, again, that's for the market as a whole, except, as I said, for this group of companies that we are talking about and what we are tracking and some of the companies that we own in our portfolio. In fact, in some of those companies, we are seeing earnings growth even happening in such times. So for this band of companies, you're going to see earnings growth happen even now and going ahead. And that's the reason you are seeing what I call as a premiumization of the market happen. The people are ready to invest into these companies and pay even a higher price because they like the earnings visibility that they're getting by investing in them.
The next question is from a participant. How much return are you expecting in the next 5 years on a compounded basis?
So, like I said, our endeavor has always been at any given point of time to look for companies who we think will double their earnings in 4 years or 5 years time from now. we think all the companies in our index, in our portfolio, and beyond that also there will be a lot of companies, I'm sure, when we come across, who will exhibit the same tendencies as such. So I think that to realistically expect if 15% bottom up return, anywhere between a 15 and 18% expectation of return is not unrealistic, because don't forget what is going to happen is that you will see after this year is out, the next year seeing a very big jump of earnings, assuming that by that time we have a vaccine in place and so on and so forth. Because this year is going to be a low base year, so you're going to see a massive jump here. And then if you come back to your normal GDP growth numbers, so you will see close to a 18 or 19%. It's very much possible that your GDP growth numbers might come back to, say, already your inflation is 6%, at 5-6% at the retail inflation and so on and so forth. So 10 to 12% nominal GDP growth, and if you assume that you are able to pick that 20% cream of companies in your portfolio, to expect a 15 to 18% return from equities over a 5-year period is not unexpected. Sure.
Yeah. Next question is from Anil Advani. Excellent presentation and strategy. However, how confident are you about the performance of the financial sector going forward?
So, Anil, interesting question. So the answer is that for the financial sector as a whole, we are not that confident. But for the group of companies that we are investing in, and that's why, as I told you, what we did is we narrowed ourselves down. We don't want to look at any also ran NBFCs. The NBFC sector is going to see tremendous pain. I don't see 90% of the NBFC stocks coming back to their previous levels as such. I see a huge consolidation happening in that sector, where the big are going to get bigger, and because they're going to get bigger and grab market share, they are going to see their multiples expand. Similarly, yesterday I was attending a CRISIL presentation on the stressed asset sector and the NPA segment. They talked about the public sector banks needing close to 35 to 40,000 crores of inflow just to meet the enhanced stress in the system. That same amount for private sector banks was 14,000 crores. Then it came down to saying that, but who's going to give this 40,000 crores to the public sector bank? If they go to the government, yes, the government perforce has no choice but to give that money. But they're considerably stretched at the present moment. And because of corporate governance issues, there is no foreign investor who's going to put money into public sector banks. But 14,000 crores for a private sector bank as an aggregator, this is, mind you, individual banks have already gone and raised more money than that, is no sweat, because even today, if a private sector bank goes and raises capital, it finds it far easy. So what's going to happen is that the share of these banks is only going to get bigger and bigger. I mean, HDFC Bank is a testimony to the fact that what has happened is how they have garnered deposits at such times when there was a flight for safety and so on and so forth. So we believe that I agree with you that the financial sector is going to be going through a stress for some time, and the longer this persists, unfortunately, that's going to be prolonged, because more and more businesses will come into stress. And not that there is an intention. I think there are two things. One is the promoters who had a bad intention are already there in the system and it's manifest. But because of circumstances beyond them, you will see a whole new bunch of promoters if this stress continues for longer. So the best strategy at such a time, because you can't be out of that sector completely, because it's the backbone of the economy. Without the financial sector, the other sectors also won't do well. So I think stay within the leaders, stay within the ones who have the best balance sheets at the present moment, and you should be okay and you will do well.
We have a follow-up from Anil Advani. What happens when liquidity dries up from RBI and government and unemployment increases?
So unemployment is already high today where we are as such. And like I said, I would believe that when I see empirically and I go out and I see everything, what I see is by the day I see more and more people out on the streets. By the day I see more and more shops opening. By the day I see more and more the stores being full more and more. So I think unemployment is already high to where it is, right? And as far as liquidity is concerned, the fact is today there is so much of liquidity in the system which is not being used. It's lying in banks. It's lying as deposits. It's going back into government securities. So I really don't see a scenario where liquidity is going to dry up. Liquidity is there and in ample. The fact is, think about it this way, right? A Reliance raises capital. It's got surplus capital sitting on it. Now it is buying over companies. So these companies who didn't have liquidity or wanted to grow are finding a new investor who has stepped in and started taking them over. Already there have been 2 or 3 small acquisitions that they've announced, right? Banks like HDFC, banks like Access, banks like ICICI, all of this money is flowing into India. So I don't see a situation where liquidity is going to dry up. I see a situation where the person who does not require liquidity is going to have more than ample liquidity, and the person who is really desperate is going to struggle for that liquidity. I think that dichotomy is going to exist. I don't see a scenario where the system liquidity is inadequate.
Right. Next question has come anonymously. Are you expecting to churn portfolio in post-COVID era?
So our portfolios get churned only in a couple of conditions. One is if we find that the investment hypothesis which made us invest has changed, or we find that the business fundamentals are changing for that industry, or say for example, the promoter has gone and pledged his shares, or it has had such a big run up, wherein we then sort of sell a little bit and raise cash by taking a little bit of the profits off the table. But otherwise, fundamentally, given the nature of these businesses, we do not churn portfolios without adequate reason.
Next question is from Amit Bharadwaj. Any thoughts why Reliance is not there in your portfolio?
So it's a good question. So Reliance was for many years had not delivered any returns, and most of its returns have come compressed in this very short period of time. We were very keen to buy the Reliance partly paid up. I wanted to, play it through that route. However, due to logistic reasons, because there are certain logistics reasons in terms of how we. I could have gone and bought the rights entitlement, but then I would have to approach each investor individually, and the time period on offer was so short. To sort of put in money for the partly paid up shares and so on and so forth. And with investors all over the world, some in the US, some here, it was a little difficult for us to manage that. But yes, at the time of the listing of the rights entitlement, we were very, very keen to buy that, because to me, that was a bigger play of making money on Reliance. Having said that, yes, I would like to look at Reliance if it corrects. It's had a sharp run up. I think over a period of time, it is going to deliver numbers. And the fact is that for the first time in many years, the management is, I think, in a value creation mode. So far, it was in the mode of building a conglomerate where profits from one business went to subsidize another business. But now that it has sharpened its focus into 3 main business segments, I think, and it has invested into this business segments. It seems to be in a value creation mode. So possibly, I mean, we might look at Reliance if and when it corrects with the market.
Next question is from Mr. Rajesh. Where do you see Sensex 1 or 2 years from now?
Rajesh, I don't know. Okay. I can only tell you where I see my stocks. The Sensex is an amalgamation of 30 companies. The Nifty is an amalgamation of 50 companies. Out of those 30 companies, 10 do well, 10 don't do well, 10 remain where they are. So it's very difficult to say. And that's why, at times, tracking the Sensex is so difficult. In fact, actually, you see, in a way, it's also very good because it makes life for bottom-up portfolio managers easy because they are able to, through their focused growth approach, be able to beat the index. But I would think that if I were to give you an answer, which by the way I think I'm very, very least qualified. A technical analyst will very quickly give you the answer. But if I were to give you an answer, typically what happens is that in market cycles, I'll try and answer it through market cycles, is when markets bounce back very sharply from the kind of bottoms that we have seen, then they tend to sort of consolidate. I don't see markets going back to those levels that we saw in March because, as I said, the shock to the market is over. The only possible shock that the market can get, if you ask me now, is from a political crisis or a war or something to that effect. But otherwise, even if it has to correct, it will correct in a very slow or a gradual manner, or it will sort of consolidate here for some time. And then as earnings start coming back, it starts making its move towards new highs. But if I were to sort of hazard a guess to your question, if you take the long-term view, markets have return numbers in line with GDP growth rates over a period of time. So at a point of time when our GDP growth rate used to be higher, the nominal growth rate was almost 13-14%. The long-term return from the index used to be 15%. As inflation came down and our growth came down, in the last 4-5 years, or anybody who has invested in mutual funds would have seen that they were making 10 or 12% sort of numbers through large mutual funds who are actually replicas of the market in some form. So I think to expect a 12% sort of compounded return from the markets is not unfair.
Next question is from Manoj Chanchlani. How do you compare earlier meltdowns and now, looking at the reasons for meltdowns being different?
So Manoj, I thought the chart answered your question when we looked at the earlier meltdowns, what we saw. See, if you really see, so the meltdowns, what we have seen can be classified into two main types of meltdown. One is meltdowns where there is a sudden shock to the economy. So like 2008 was a shock and you saw a 60% drawdown. Then there were slowdown-led drawdowns, right? They were not meltdowns. They were gradual, as the chart will show you. They were gradual drawdowns, right? That was reflecting that the economy was slowing, things were not looking good. Again, this meltdown, if you would already see, the shock, as I mentioned time and again, is behind us. Because, frankly speaking, when we were there in the middle of March and everything was shut down overnight, COVID was rampant and very, very less was known of the disease. We did not even know that a chloroquine can work, or there were no names such as remdesivir, chloroquine, and so on and so forth. At that point of time, we were in a state of shock. We didn't know what is going to happen tomorrow. Companies looked like they were defaulting, credit markets were seizing. So every time, if you really notice big shocks, these shocks cause a credit freeze, that causes a big fall. a slowdown in the economy and other factors don't cause a credit squeeze, and the economy and the markets come down very gradually. And if you go through history, you will see the similar scenario. And same thing happened in 2000, same thing happened in 2008, and now we saw it in the recent past. So frankly speaking, if you ask me what is the big difference, that is the big difference between what we term as meltdowns and other drawdowns. Again, as the chart showed you, your stocks, if they are picked well, it really doesn't matter whether you're in a meltdown or no meltdown. You'll end up making money over the long term. Hello? Jay?
Hello. Yes, hi. Next question from GVS Ramaya. PM's vision of a 5 trillion economy and present valuation of 2.3 trillion. Is it practically possible to achieve PM's vision? If yes, which sectors will play a major role?
So I'm a cautious optimist. I would love to see the 5 trillion from an India economy. Unfortunately, India has always faltered to deceive. For all the potential, for all that we have going for us in terms of resources, in terms of people, in terms of everything, we have always held ourselves back, and we are the only ones responsible for where we are today. Nobody else, as such. So I think the 5 trillion target is a commendable target. To get to that target, in my own view, a considerable amount will have to be done from a perspective of getting Make in India or manufacturing in India going. Our manufacturing GDP has, share of GDP has come down over the number of years, because manufacturing as an operation, A, draws in FDI flow, B, it creates employment, more in big numbers, and C, it also acts as the bedrock for possible exports in the future. So I think to get to that scenario, I think manufacturing will play a key role. Of course, agriculture also has to play. Agriculture accounts for 15% of economy and 40% of manpower. So that also has to play its part, because it's 40% of manpower are sitting on 15% of the GDP contribution. So if that also grows, like the PMS also had a vision of doubling farmer income and so on and so forth. So I think these are notable vision or benchmarks that he has set to strive for. I think even if we get to 60-70% of that number, I think it's a very good number to come to. Which are the sectors which will do well from an India perspective? I think, if you ask me, the services sector will continue to be the bedrock of the economy, and they will continue to do well, whether it is telecom, whether it is newer areas that are opening up. So, for example, you have these shared mobility, and all these new sectors are employing more and more of the youth of the country and people of the country. I think pharmaceuticals, people are looking for de-risking from China. So I think the entire pharmaceutical, chemical, agrochemical chain is going to see an investment. I won't be surprised if we see some form of investment also happening in the auto ancillary sector, considering the amount of imports that yet take place from an India perspective from China and so on and so forth. So I think, but these are all a part of manufacturing again, like I was telling you. So I think these are the sectors that will do well. I believe that the IT sector will do well. I think the entire digital sector is going to grow bigger and bigger and bigger. It's already gotten so many, India already has so many new unicorns, in that piece. And I think that has, we've traditionally always been an IT services economy. the kind of money that has flowed in, we've seen into the Flipkarts or the Paytms and other such companies in India, the Zomatos and so on and so forth, is now encouraging more and more people to move in that direction. So I think that segment, and by the way, that entire segment is not even there as a part of market capitalization today. So, in the last few years when the economy was actually struggling and the market earnings were struggling, you had this segment of the market which was attracting so much of money, which was not even reflected in the economy and so on and so forth. So I think that is another sector that will do well going ahead.
Next question. Earlier we saw for 2008 crisis, market dropped close to 60%. Whereas for COVID, we are seeing a drop of 38% so far. Will markets drop further given the crisis has a more global or a longer term impact?
So can the markets go further? Answer is yes. Will they go further? I very much don't think so. Like I mentioned earlier, in the 60% drop that you saw in 2008, there was the shock of the lemon crisis, and the resultant credit freeze that happened in the US and global economies, which the Fed stepped in and arrested. That became the template for the Fed to run and the central banks all over the world to run markets in the last 10, 12 years. So the moment this time the similar situation started happening because of COVID and lockdowns, central banks jumped in along with the treasury and they unleashed this huge bazooka of money. So again, the credit squeeze or the credit freeze that was there got arrested far earlier than we saw in the 60%, because that was again the first time it was happening after the Great Recession. So by the time market, the Fed and everybody got into action and started putting in, you had already seen a big drawdown happen. This time around, they reacted far faster and far quicker. And that's why you didn't see 60%. So I frankly don't see 60% or even 38% happening to me. To me, a more likely scenario at the cost of looking foolish is probably a 10 or 15% sort of correction. Even that, if you honestly ask me, will happen. Not now. It will happen when COVID is over. Right now, my own view is that the Fed has created an open-ended situation. They've said they are going to support markets and do whatever it takes. Now, when you have an unlimited amount of liquidity, and who's going to argue with the Fed? Are you going to go and short the markets if you know that the Fed is going to come and buy it? And they've said they're ready to buy junk bonds, they're ready to buy stocks, they're ready to buy anything. So who will have the guts to go against that? So that is as far as the Fed is concerned. But because of that, global money is sloshing around and flowing and is moving to India also. So while the Indian central bank is not directly buying Indian stock or Indian bonds, it is providing liquidity and more. So I think the Fed put acts as a base to not allow the markets to go down. My own view is once COVID is over and central banks all over the world say, okay, listen, we're not going to be spending this kind of money any longer. That's when you will start see a correction of any sizable degree take place in the market. And I think that is yet some time away.
Next question is from Mr. Rakesh Prasad. In present scenario, in which sector should one invest?
So Rakesh, frankly speaking, we follow a sector agnostic approach. But if you were to ask me which are the sectors which are seeing strong visibility of growth, the chemical sector is seeing visibility of growth. Agrochemicals is seeing visibility of growth. Pharmaceuticals is doing well, especially the ones who are in the API, which is the active pharmaceutical ingredients. These stocks have also had a fair run up and are trading at, I will say, not so cheap valuations. But if you were to get an opportunity to buy into them, you should. I think the telecom sector, it looks interesting from a valuation perspective. According to me, even the city gas sector, wherein you have Indraprastha Gas and Gujarat Gas, are interesting segments to grow. Also, as you see things turning around and the intensity of the cases diminishing, you could start looking at consumer and retail oriented sectors, considering the amount that they've been beaten up.
Next question has come anonymously. What is your thought on high dividend paying stocks? Do they inherently suffer in growth and hence not part of your strategy?
So, we like dividends, but we look at dividends as a check telling us that the profits actually exist. Companies very often tend to show profits, but they don't have cash flows. So we like dividends from our companies, but to us, that is more reflecting, like I said, that these profits are genuine and they're actual profits and not just book profits. This whole approach of investing in dividend yield stocks is good for people who are comfortable with that. We are growth investors. We believe that India is a growth economy. We think that given our demographics, given our and the hunger for growth that you see in the young population of wanting to grow, all the young population that is there, they want to grow, they want to evolve, they want to see and move on to a better life. So we are a growth economy. So we prefer the growth investing approach than the dividend approach, because while a dividend approach is good, it's yield based as such, we see better returns coming from growth rather than dividend. So for us, it's a preferable, that's our preference as such. Having said that, if you as an investor are comfortable holding high dividend yield stocks and you could see a peculiar characteristic in that, and that is that high dividend yield stocks continue to pay high dividends for extended period without doing anything in stock price, and then there is a growth trigger that happens and suddenly the stock price runs up and so on and so forth. But our mandate in the PMS is growth investing.
Next question. Any thoughts on proportion of new IPOs expected from startups currently heavily funded by VC PE funds?
Yes, surely. I think if the experience of India-Mart and other companies are anything to go by, you will see a lot more startups come into the capital markets and get listed. I just don't see them happening in the immediate future. They will probably take some time, because this whole COVID episode has actually pushed back growth numbers for these companies by at least a few years.
Next question is from Mr. Bharadwaj. Do you think IT companies will continue to enjoy higher valuations? Why don't you have IT companies in your portfolio?
So, Mr. Bharadwaj, for us, unfortunately, those IT companies have not been able to satisfy the criteria of doubling earnings in 4 years' time or 5 years' time. And if they have, maybe we missed some of them. But by and large, as a rule, most IT companies have been growing their earnings at 10%, 8%, 12% numbers, which does not come into the criteria of doubling. In the past, we did own IT stocks. At a given point of time, I remember we had HCL Technologies in our portfolio. We do look at IT stocks because we think the management is of good pedigree. They are good businesses throwing out cash, no debt, and so on and so forth. And at a point of time when things were going really bad, we were even thinking of investing in them more as a defensive play and parking money. But by and large, since they do not meet our criteria of companies who are doubling earnings in 4 years' time, we have not been able to find companies to companies within the IT sector to fit in there.
The last question is from Mr. Kulkarni. Somehow the world economy is dependent on the US. Do you think the results of the US election could be a trigger for the markets?
If you go by what has been talked about and discussed in common visit, the if Trump comes, apparently the markets will do well. If Trump doesn't come and Joe Biden comes, you might actually see a correction in markets. Primarily because Trump has been so much pro-market in terms of all his policies and so on and so forth, and the kind of liquidity that he has infused. And Joe Biden has a little bit of a leftist. The Democrats have a little bit of a leftist leaning. I think that's going to be temporary, frankly, if you ask me. I think the more important thing, if you ask me from a US perspective, again, in the US markets, I think the same logic that I told you about, that as long as there's so much of liquidity that is flowing in, markets will do well. The moment the COVID crisis eases out, people are going to start looking at earnings. Fed is going to say, listen, we are not going to be supplying that much liquidity. We are going to be now putting things on hold. That hold of the Fed balance sheet, even if he's not contracting, even if he's holding it, is probably going to see the market start correcting. That's going to happen globally, in my view. It's going to be in some sense a little bit similar to the taper tantrum or the D3 that we talked about in our presentation. So I think the US, otherwise I think, again, out there also what's happening in the US, if you see the Dow Jones and the NASDAQ performance, there's such a big difference. Again, within the NASDAQ, if you see the top 5 or 10 stocks, the FANGs and so on and so forth, and Microsoft, and they have given some stellar returns which are disproportionate to the index. So it's going to be very, very stock specific. The fact is that these stocks are overpriced. They are close to peaks. I don't say peaks, sorry, I take back my word, not peaks, but at their all-time highs. Can they go up from here? Answer possibly is yes. Can they correct? Answer, a greater possibility is yes. But after correction, will they go back to newer highs? The answer is yes, because we are moving into a digital era. We are in a digital era, and more work is happening in a digital era. So when you invest in such stocks, even at the wrong time, what you lose out is more from it, the time that you have to sit into the investment rather than on the capital. And again, this similar theory, if I have to end this presentation or bring it to close, is that if you invest in these quality stocks that we talked about, even if there is a correction, it's the time that you have to spend in the investment that increases, not your risk to capital. So if you have these high growth companies with good balance sheets, you should be invested, because given alternatives of fixed income or other asset classes or even real estate, equities seems to be one of the most attractive asset classes in our view for the next 5 years.
Nitin, I would just like to squeeze in two questions that just came in. These are so the question comes in from Vijay Chug. Do you think all banks are now safe, especially banks like IndusInd Bank?
So I think the crisis in the banking sector, so banks, normally face two types of crises, right? They face a crisis where they lose confidence and there's a run on the books. So people withdraw deposits and there is an absolute panic. And even a good bank, considering, don't forget, in a bank, normally about the capital adequacy ratio is 14-15% and 85% is leverage. So if you see a big drawdown in your capital or deposits, that could actually cause a liquidity crisis in banks. The other is that the bank is systematically badly run, like was the case with Yes Bank, and that causes the crisis to happen. I think by and large, if you ask me, the crisis as far as the overall banking sector in terms of panic is beyond us. There will be selective issues with banks with regard to their book that will take place, which is a function of how long this crisis elongates or persists as such. So if you ask me, but however, I do believe that the top private banks and IndusInd being where they within that is relatively fine. I mean, it might not deliver, its valuation is very cheap as a stock, and that is because there is yet a little bit of fear and apprehension over it. But I think by and large, I don't think it is going to go through what Yes Bank went through. I don't think it is going to collapse.
We have a follow-up from Mr. Chug. Do you think that if Trump does not make the next term, international trade will improve as some tariffs may be removed?
Most definitely, I think, if some of the barriers are removed, international trade will improve. But I think international trade is going to find its way around even if Trump is there with all the barriers and so on and so forth, because there is only so much that the US can do finally and such. And, but yes, most definitely without the obstacles that Trump has put and the inward-looking behavior that the US has gone through, if that is out, international trade will most definitely be much better off in a post-Trump era.
The final question, as a foreign investor, if and why should investing in Indian market be lucrative as compared to, say, other markets like China, Singapore, or the other ones in the APAC region?
So I think, don't forget that, look, India is among the top 5 or 6 countries in the world in terms of its size of GDP, right? It's got this whole demographic dividend that is playing itself out for itself. And globally, wherever countries, if you really see countries all over the world, demographics have played a huge role in terms of the growth of those countries. So Japan might have a huge economy, but it's got such a old demographic profile that it's just not able to grow, because it's the young who want to grow, the young who want to consume, the young. And India has yet to invest so much as far as infrastructure is concerned, so much as far as aspirational consumerism is concerned, and so on and so forth. So I think, will India get to be among the top 3 or 4 nations 10 years from now? The answer is yes. I firmly believe so. So would you not want to be in those, in the top 3 or 4 countries in the world, given its demographic profile? Answer is, you could possibly just remain in the US, like Warren Buffett has for majority of his life. Now he has moved to China. But even he had to move to China when he saw the kind of size China was getting to. And so similarly, if the aspirational 5 trillion GDP growth rate, which the Prime Minister has talked about, comes, India is going to be among the top 3 or 4 in the world. Given that, it's too big an economy to ignore. And that's one of the reasons why you're seeing so much of, the fact of the matter is, we individually can look at it, but why would a Facebook, why would a Apple, why would a Google want to come and invest in India if it was not seeing the kind of growth potential that exists in India? Against that, of course, the depreciation of the rupee has always been our concern. But, and that's why my own belief is that when you are invested in high growth companies who are doubling earnings every 4 years or 5 years, you will even be able to, surpass that drawback of a rupee depreciation. But I don't see any reason why, when you have the 4th or 5th largest, yes, some of these countries could, Singapore, I mean, is India ever going to be as well or efficiently run as Singapore? I don't think so. These are smaller countries, well managed and well run. India is not a country, it's a continent. I think it's about 24 or 25 countries within one country. So it's always going to be a disparate, non-homogeneous lot. But the kind of entrepreneurship that prevails in this country, the kind of dispersed industries that prevail in this country, so you have consumerism, you have infrastructure, you have agriculture. All of these means that there is a wide diaspora of businesses to choose from when you invest in this country. That's why even in such times which are bad times, you're able to find opportunities where you can invest, and so on and so forth. So I think you can ignore India, but it has to, global investors, large funds, global funds cannot ignore India. An individual might decide to ignore India, but I don't think global funds can.
Due to time constraints, that was the last question.
Thank you, everybody, for your patient hearing on a Friday evening when I'm sure you would like to catch up with your family. Thank you for your time. I look forward to many such interactions with you. Again, thanks to technology. And I think, we plan to do this on a monthly basis. I look forward to seeing familiar names and many more going ahead. Thank you again.
Nitin, thank you very much. I think that was the most in-depth presentation and an extensive presentation. From the kind of questions we saw coming, I'm sure, a lot of attention has come to this PMS and the stellar growth that you have shown. But of course, because of time constraint, we couldn't take on. I am seeing more questions coming in. So, but yes, we'll take those questions offline. And thank you very much. It was a wonderful presentation. Thank you to all the investors who logged in on this Friday evening. We'll probably come back to you again very soon. Thank you. Good day.